What if the biggest risk to US equities right now isn't just inflation or interest rates, but a whole set of hidden structural pressures quietly building up behind the scenes? Hey all, welcome to ShareTreck, where science meets investments, and I'm your host Raj. Friends, today I want to talk to you about a growing list of signals that I think point to elevated downside risk for US equities as we move towards year end. None of these risks alone could be a major red flag, but taken together, they paint a picture of a market stretched across supply chains, funding markets, energy constraints, and global capital flows. Let's walk through what's actually happening and why it should matter for us retail investors. US inbound container data has been softening. Some months are showing year-over-year declines of around 12%, particularly in goods arriving from major manufacturing hubs and into US. At the same time, several retail and manufacturing categories are reporting pockets of inventory buildup. That combination, slower imports plus higher inventories, suggests consumer demands may already be weakening heading into the holiday season. Historically, this setup usually leads to margin pressure, discounted selling, and softer earnings in discretionary sectors. Friends, if you're finding these kind of breakdowns helpful, please press the like button. It helps more investors like you discover this channel. That said, next let's talk about the part of the market nobody can afford to ignore: US Treasuries. Recent analysis from the Federal Reserve highlights that a large portion of Treasury cash futures basis trades is being driven by hedge funds domiciled in the Cayman Islands. These positions may account for almost as much as $1 to $1.4 trillion in Treasury exposure that doesn't show up properly in traditional cross-border data. The question is then, why does this matter? Well, I think it matters because this trade is leveraged and depends heavily on repo market funding. If funding costs rise or liquidity tightens suddenly, these funds may be forced to unwind positions quickly. A sharp unwind can spill into treasury yields, corporate credit, and ultimately equities. This is one of those quite structural risks that doesn't show up in the headline until it breaks. Then let's turn our attention to the tech sector, and especially AI hardware. I think AI hardware is facing its own set of pressures. Many hyperscalers are using a 5 to 6 year depreciation schedule for GPUs and AI accelerators as per every note that I have read so far. But several analysts argue that the economic life cycle of this hardware may actually be much shorter due to rapid performance leaps and competitive cycles. If that is true, companies would need to refresh hardware faster than their accounting assumes, meaning higher capex at a time when liquidity conditions are already getting tighter and the investors are already concerned about the level of investments that have already been put into data centers and AI infrastructure. On top of that, large data center operators have started flagging power grid constraints as a real bottleneck. In simple terms, we can build more clusters, but we can't power them. We can't power them fast enough. Multiple analysis from think tanks and energy consultants warn that the US grid is not prepared for the pace of AI expansion. If that grid comes to the limiting factor, then AI infrastructure growth and the earnings tied to it, including Nvidia and its sales projections, could slow down. Now let's go global. Zooming out, for years, Japanese investors have borrowed heavily in yen at ultra-low interest rates to buy higher-yielding US assets. This is the classic yen carry trade. But recently, Japan announced a US $135 billion stimulus package, and Japanese bond yields have been rising. If these policies cause the yen to strengthen, even modestly, it increases pressure on investors holding US stocks and bond funded with yen debt. On the other hand, a stronger yen can trigger repatriation flows out of US markets, and historically, unwinding carry trades has created real turbulence in risk assets. If you have been following our pre-market live streams, I spoke about the US JPY currency combination, and Japanese yen has been becoming weaker and weaker, which basically means that people who have borrowed in Japanese yen and invested in US dollars can now pay back their yen debt at a much lower price and in fact pocket some profits. And that could come in handy, especially when the US economy itself is suspect at this point of time, and the possibility of yields rising in the Japanese bonds. So we have to keep a lookout on that aspect. Now, putting it all together, so what does this mean? Okay, on their own, each of these risks could be managed, but together they weave an uncomfortable narrative. Slowing goods flow into the US, early signs of inventory pressure, a treasury market leaning on leverage basis trades, tech hardware with shorter useful life, and strained power supply which prevents its further growth. A vulnerable yen carry trade that could reverse at a moment's notice. Individually manageable, but together a setup for high volatility and elevated downside risk. And friends, there is also a movement going on with Bitcoin. Lots of people who hold Bitcoin and are watching the downslide of Bitcoin are getting a bit alarmed as we fall below the 50-day exponential moving average. And that 50-day average has always been a kind of border beyond which we start the bear market for Bitcoin. So that's another area where one needs to watch out, because if monies were borrowed and invested in Bitcoin, and you could have some kind of margin call situation coming in, or something equivalent to that coming in, where people would want to sell more of their Bitcoins and cut their losses. Well, friends, these are my thoughts. I would like to hear from you. Even though we saw S&P 500 recovering a little bit today and NASDAQ recovering a little bit today, I still think that we are on the downtrend as far as the indices are concerned in the US stock market. And most of the down movement or up movement in the charts do not come in a straight line. They always have a little bit of up and down on their way down, and likewise on the way up. So I'm thinking that the gains that we have seen today is just momentary gains. I'd like to hear from you guys. What are the things that are keeping you awake at night in terms of market risk? Please put that in the comment section. Let me know if I have missed something. Remember, this ShareTreck channel is basically for retail investors. We are trying to build a retail investor community which can crowdsource market intelligence as well as trade ideas. So if you have any ideas or intelligence, please contribute to that in the comment section. It will help me as well as the entire ShareTreck community. Thanks for watching this video, and if you have not yet subscribed, why not subscribe? It's absolutely free. And if you are on the go, you could just subscribe to my Substack. It's absolutely free. Every long form video here would have a Substack article which may potentially have a little more information than what I can put in the video format. Well, friends, that brings me to an end of this video. I hope you have a great weekend, and I'll catch up with you again in the next video. Bye for now.